Welcome back to One Patch Code, the podcast where we demystify complex tech topics. I'm Matthew, and today we have a truly insightful guest joining us, Yves, an expert in Python for algorithmic trading. Yves, welcome to the show.
Thanks for having me, Matthew. I'm excited to be here.
Absolutely. We're diving deep into the world of Python for algorithmic trading. Specifically, we're looking at the book Python for Algorithmic Trading. Now, Yves, you've touched on the impressive decline in the number of share traders at Goldman Sachs, down to just 2 from a high of 600. Can you shed some light on why this happened and how it might connect with the need for automated trading strategies using Python?
Absolutely. That's a really interesting point. The reduction in human traders at firms like Goldman Sachs is largely due to automation. Financial markets are moving towards highly sophisticated algorithmic trading strategies. These automated systems are able to execute trades at incredibly high speeds, potentially making them much more effective than human traders who are limited by reaction time. These systems can analyze massive amounts of data, identify patterns, and execute trades based on complex rules. Python's versatility and robust libraries for data analysis and machine learning make it a perfect tool for developing such systems.
That makes perfect sense. So, the book you mentioned, Python for Algorithmic Trading, covers how Python helps build these automated trading strategies, right?
Exactly. The book touches on various critical aspects of this field, including Python deployment, interactive financial analytics, machine learning, object-oriented programming, and even socket communication. It shows how Python can be used for everything from basic statistical analyses to quite advanced machine learning models in a financial context.
That's impressive. What about visualizing streaming data? How does Python come into play there?
Visualizing streaming data is crucial for understanding market trends in real time. Python libraries like Plotly and Matplotlib excel at this. These libraries help to create interactive graphs and charts that update as new data arrives, allowing traders to quickly react to market fluctuations. And, the book also explores different trading platforms and how to integrate Python-based algorithms with them.
This all sounds really complex. What are some of the fundamental Python concepts that a reader should be familiar with before they delve into this book?
A basic understanding of Python programming, including data structures like lists and dictionaries, is crucial. Familiarity with libraries like NumPy and pandas for data manipulation and analysis is also very helpful, along with an understanding of functions, classes, and objects. We go into much more detail, in the appendix, but having that foundation will make the rest much easier to grasp.
Excellent. This sounds like a fantastic resource. We'll delve into more specific examples and details in future segments. Thank you, Yves, for joining us today.
Thanks for having me, Matthew.
So, Yves, you mentioned that Python's slow interpretation speed was a major hurdle for financial applications. Could you elaborate on why that's a problem, especially when dealing with numerical algorithms?
Yeah, absolutely. A lot of financial algorithms, like option pricing models or risk management calculations, involve a lot of numerical computations. And these computations often rely heavily on nested loops. Now, these loops, they're super common in programming, but they can be a performance bottleneck in interpreted languages like Python.
So, if Python is interpreted, how does that affect its speed compared to compiled languages like C or C++?
Well, interpreted languages like Python, they read and execute code line by line. Think of it like a translator constantly converting instructions to something the computer understands on the fly. Compiled languages, like C or C++, create a direct set of instructions for the computer to execute. This direct translation is what makes compiled languages blazingly fast, particularly when dealing with repetitive tasks, like those nested loops. The compiler analyzes the code in advance, generating highly optimized machine code that runs super efficiently. So when you have many loops involved, the speed difference between interpreted and compiled languages becomes more noticeable.
Right, I get it. So, pure Python isn't ideal for these intensive calculations because of the interpretation overhead?
Exactly. Pure Python, in most cases, is significantly slower than using C or C++ for these numerical-heavy tasks. In a financial context, where millisecond differences can make a substantial difference in the outcome of complex financial models, this becomes a huge consideration. Which is why, often people will use Python for the higher level logic and then use compiled languages like C or C++ for the computationally intensive parts.
That makes sense. So, what are the strategies for tackling this performance issue within a Python-based trading environment? What techniques or libraries could we be using?
Great question. There are ways to mitigate this performance disadvantage. One common approach is to leverage libraries like NumPy, which uses optimized C code underneath, allowing for numerical computations to be significantly faster compared to pure Python loops. Libraries like pandas, which are also built on top of optimized C code or other compiled languages, let you use high-level Python syntax but benefit from the speed of compiled routines. This way, you gain Python's readability and flexibility while maintaining a faster execution speed in a lot of numerical situations. You also have libraries like Cython, which allows you to create Python code that is heavily optimized through using C code directly within Python.
That's fantastic. So, we're trading off readability and simplicity of Python with speed using these libraries. That makes a lot of sense. Okay, Yves, we're diving deeper into this Python versus pseudocode discussion. You mentioned that Python syntax made pseudocode steps unnecessary in many financial algorithms. Can you elaborate on that?
Yeah, absolutely. Historically, when explaining a financial algorithm, a common step was to present pseudocode as a bridge between the conceptual idea and the actual Python implementation. People found it useful for clarity. But Python, with its readable syntax, often allowed you to directly express those algorithms quite concisely and clearly in the code itself. It's a lot more like the underlying mathematical formula,
Right, so the pseudocode step became less crucial because of Python's readability. But you also mentioned a specific example, the Euler discretization of geometric Brownian motion. Could you unpack that for our listeners?
Sure. That's a common method to approximate the path of an asset's price, which follows a stochastic process. The formula itself, shown in both LaTeX and Python, demonstrates this beautifully. You've got the underlying stochastic differential equation, and Euler discretization is a way to calculate a discrete time series of asset prices based on those equations. The LaTeX and Python representations visually map directly to the underlying calculation.
So, the mathematical formulation is clear, and the Python code mimics that with the exp function for the exponential and operators like asterisk and asterisk asterisk. This makes the code easy to follow and comprehend, right?
Exactly. The Python code, st equals s underscore 0 asterisk exp, r 0.5 asterisk sigma 2, asterisk t plus sigma asterisk z asterisk sqrtt, closely mirrors the LaTeX representation. It's really just translating the mathematical notations into a form Python can execute. The variables have specific meaning. S underscore 0 is the initial asset price, R is the risk-free interest rate, sigma is the volatility, t is the time horizon, and z is a random variable, for example from a normal distribution, representing market movements.
Okay, I understand the elegance. But you also highlighted a speed issue. What's the connection between the ease of use and the speed limitations?
The readability and expressiveness of Python come at a cost. Python is an interpreted language. This means the code isn't directly translated into machine instructions. It gets translated in stages, leading to a slower execution speed compared to compiled languages like C++ or Fortran. This difference becomes significant when you're dealing with millions of simulations in Monte Carlo methods for derivative pricing or risk assessment. Those simulations take time to complete. Python might not be the fastest choice if you're running such computations, particularly needing near real-time analysis.
So, if speed is the concern, why not use a compiled language? That would be faster.
Absolutely. For computationally intensive tasks where speed is critical, like high-frequency trading or large-scale risk management, using optimized compiled languages, e.g., C++, Cython, or parallel programming tools is vital. Python is more suitable for the initial prototyping and the initial stages of the algorithms. This is when its ease of use for rapid development and testing is advantageous. Then for high-performance needs, you can optimize critical parts of the algorithm by compiling them to C++, thereby increasing execution speed.
Welcome back to the podcast, Yves. We're diving deeper into Python for algorithmic trading. And today, we're focusing on NumPy, a crucial component. So, NumPy, you mentioned it's about numerical Python, right? What makes it different from the standard Python interpreter?
Yeah, absolutely. The base Python interpreter is designed for general-purpose programming. It's incredibly versatile, but it can have overhead, especially when dealing with numerical computations. Think of it like a very flexible car, great for driving around, but maybe not the fastest for a race. NumPy, on the other hand, is highly specialized for numerical operations. It's like a race car, optimized for speed in specific scenarios.
So, you're saying NumPy is all about speed? And how does it achieve that speed? I mean, the chunk shows a noticeable difference in computation time between the pure Python code and the NumPy code.
Exactly. It leverages vectorization to dramatically boost speed. Instead of looping through elements in Python, NumPy handles large arrays of data in a single operation using highly optimized C code. That's why you see such a significant time difference. It avoids all the extra overhead of Python's general-purpose operations and delegates the computation to machine-level efficiency.
And this vectorization is really built around the array object, right? Can you explain that a bit more?
Right. The array, n-dimensional array, is NumPy's fundamental data structure. It's crucial for vectorization because it's designed to hold homogeneous data, meaning all the elements in the array are of the same data type, like all numbers, which makes things much simpler.
Homogeneous data. That's important. And why is it immutable in size?
Because immutability allows NumPy to pre-allocate memory and optimize data access. It also simplifies the design and operation of functions that operate on the arrays, and that leads to speed in operations like vectorized calculations.
Okay, so the example they give with Monte Carlo simulation, 1 million simulations, that example really highlights the difference between pure Python and NumPy. Can you walk us through that a bit?
Absolutely. The pure Python code, had a large for loop for calculating each end-of-period value. That's very computationally expensive because it involves a lot of Python function calls for math operations at the Python level, resulting in a lot of overhead. The NumPy version, it uses vectorized operations. Instead of individual calculations within a loop, a single NumPy line of code calculates all the values for our array simultaneously, essentially doing the same thing without the loops. This allows you to do extremely massive calculations quickly.
That's incredible. So, why is this important for algorithmic trading? Is it just about speed, or are there other advantages to NumPy in trading?
Well, speed is critical. In financial simulations and calculations, fast results are essential, and NumPy provides a way to generate the results in extremely short durations. The code also becomes more readable and concise when you use vectorization, making it easier for maintainability, code comprehension, and debugging. Beyond speed, using NumPy makes your code much more efficient and easier to manage, which is invaluable for trading strategies that run numerous simulations and analysis.
Welcome back to the podcast, Yves. We're diving deeper into this fascinating book, Python for Algorithmic Trading. We were just discussing the power of pandas and how it revolutionized Python for financial analysis, especially in the context of time series data. You mentioned that pandas data frame class mimics R's data.frame. Can you elaborate on that connection?
Absolutely. It's a really important point. Wes McKinney, the creator of pandas, was working at AQR Capital Management, a huge hedge fund. And hedge funds deal with massive amounts of time series data. Python, at the time, didn't have a great solution. So Wes saw a need and basically designed pandas to replicate what R, the statistical language, did really well, manage those time series in a similar way. That's why you see this data frame class in pandas, which directly parallels data.frame in R.
Right. So that was the key motivation. And then AQR open sourced it. Why was that a smart move?
Well, it was a win-win. AQR, while focusing on its core business, benefited from the broader adoption of pandas within the financial community. They clearly saw its potential beyond AQR's internal use. Open sourcing meant many developers could contribute, improve the library, and use it for more than just financial analysis. This created a massive community around pandas, which in turn led to an amazing ecosystem of support, improvements, and integrations.
Interesting. And you pointed out that pandas, coupled with open data sources like Quandl, lowers the barrier to entry for doing sophisticated financial analysis. Can you give us a concrete example? like the Bitcoin example in the book.
Sure, the book shows how easy it is to get historical Bitcoin exchange rate data using Quandl. The code snippets, while omitting the graphical styling, essentially demonstrate how a few lines of Python, with pandas and Quandl, can get that data, and then calculate a moving average.
Okay, let's break down the example. You mentioned retrieving data about the historical exchange rate in USD. Can you detail the steps involved?
First, you import the necessary libraries, like Quandl. Then you'd use the Quandl API to get the data, and the beauty is that Quandl returns a pandas data frame. This data frame already has the structured data, so you don't have to build the structure yourself. Then you calculate the simple moving average, SMA. The code uses the dot rolling method of the data frame object. You essentially apply the calculation over a sliding window to the value column representing the exchange rate. The mean part computes the average over that window. Finally, you plot the original data and the moving average on the same graph using the plot method of the data frame.
So, essentially, this is a pretty straightforward way of doing technical analysis, right?
Precisely.
It's impressive how powerful and accessible these tools are. It really democratizes this type of analysis, even for students or someone with limited programming background. What other tools does the book touch upon beyond NumPy and pandas?
The book mentions various tools for data retrieval and storage, such as Pytables, TS-tables, and SQLite. It also highlights machine learning and deep learning packages like scikit-learn and TensorFlow, and even promises to develop some custom classes and modules to make algorithmic trading more efficient. So, it's not just about the foundational libraries, but also about building on top of them for more intricate applications.
Welcome back to the podcast, Yves. We were just talking about the broad strokes of algorithmic trading.
Sure, Matthew. It's crucial to understand that algorithmic trading, unlike some mathematical algorithms, doesn't always have a single, perfectly defined objective. These trading motives are different drivers. Beta trading, for example, is all about tracking a benchmark, like the S&P 500. Imagine you want to replicate the market's overall performance. ETFs that mimic the S&P 500 are used to achieve this passive index-following strategy. It's essentially betting on the market as a whole, and not trying to beat it.
Okay, that's pretty clear. What about alpha generation? This seems more active.
Exactly. Alpha generation is about generating returns above the market's performance. So if the market is up 10%, you're aiming for more than that. It involves strategies like short selling, or trying to find undervalued assets. Essentially, it's about beating the benchmark, and that's where the real challenge comes in. It's not just about replication, it's about identifying and capitalizing on inefficiencies in the market.
You mentioned static and dynamic hedging. Can you give us a practical example of how these work in the context of algorithmic trading?
Sure. Static hedging, uses strategies like buying out of the money put options to protect against potential losses. It's a one-time action to reduce risk. Think of it like insurance for your portfolio. Dynamic hedging, on the other hand, is more active. It's about constantly adjusting your portfolio to counter market fluctuations. Think of it like a constantly adjusting risk management strategy. Often, it uses futures contracts and other derivatives alongside cash or money markets to maintain a certain portfolio level.
That makes sense.
Precisely. You dynamically adjust your positions to maintain a desired exposure to market risk. This is often complex, even for sophisticated algorithms, because of the need to continuously rebalance.
And then asset liability management, market making, what are the key concepts there?
Asset liability management is a crucial strategy for financial institutions. They use trading strategies to manage the risks associated with liabilities, like life insurance policies, for example. Market making, well, that's about providing liquidity. Imagine providing bids and asks for a certain asset, ensuring people can buy and sell easily.
Fascinating. So, different motives, and for some of them, the very nature of the motive requires dynamic response mechanisms to fluctuating market conditions. So, technology becomes super critical.
Absolutely. As the market becomes more global and information flows instantaneously, technology is key to executing these sophisticated algorithms quickly and efficiently. We've moved from open outcry to electronic trading systems. The pace and volume of trades have changed dramatically.
And finally, You touched on the fascinating comparison between algorithmic and human trading strategies. What are the takeaways from those studies?
Well, research suggests that while some human traders consistently outperform benchmarks, statistical analysis shows that a large majority of active managers struggle to beat the market consistently. This empirical data suggests a complex interplay between human skill and algorithmic efficiency. Algorithmic strategies can be effective in certain areas, particularly in macro-related hedge funds, while human traders with experience might still excel in other niches. The performance varies significantly across strategies and investment types.
Welcome back to the show, Yves. We were just talking about Python's rising popularity in algorithmic trading, and it's clear there are a lot of reasons for it. Could you elaborate on those data analytics capabilities? How exactly does Python excel in managing financial data compared to other languages?
Absolutely.
So, it's not just about getting the data, but also preparing it for analysis, right?
Exactly. Modern trading platforms, like FXCM and OANDA, offer these powerful APIs, RESTful and socket APIs for live and historical data. Python's extensive libraries make interacting with these APIs straightforward. There are various tools and libraries readily available for handling the API requests and responses. You can easily construct the necessary HTTP requests to gather information, parse the JSON or XML responses, and process the data obtained. It's really streamlined compared to working with other languages, where you might have to build more of the infrastructure from scratch.
Right. And you mentioned dedicated packages specifically for algorithmic trading. Can you give a few examples and explain their usefulness?
Sure. PyAlgoTrade and Zipline are great examples for backtesting trading strategies. They provide frameworks for running simulations to evaluate the performance of different strategies without risking real capital. And Pyfolio is fantastic for portfolio and risk analysis once you have your trading history. It helps you visualize and analyze risk factors, return metrics, and overall portfolio performance.
So, backtesting is a crucial aspect of algorithmic trading. These packages, then, are very important to test the robustness of a strategy. Also, you mentioned vendor-sponsored packages. Why are those significant in this context?
Well, vendors like OANDA and data providers like Bloomberg and Refinitiv, they release open-source Python packages to help their users integrate with their services easily. That makes accessing their advanced data and functionalities much simpler for algorithmic traders. They've already done a lot of the heavy lifting in terms of interface building, so you don't have to reinvent the wheel. This collaboration is a big plus for the whole ecosystem.
And the dedicated platforms like Quantopian, what makes them stand out?
They provide a standardized backtesting environment where you can test your ideas in a controlled, shared space. Quantopian, especially, fosters a community of algorithmic traders. It has a rich history, over 300,000 users until 2020, and they've seen significant buy and sell-side adoption from institutional players. It's a great space for learning and collaboration in the Python algorithmic trading community. This is further reinforced by the massive increase in Python training materials. The combination of educational and professional resources really bolsters the whole market.
That's really insightful, Yves. It's clear that Python is not just a language but a valuable tool for algorithmic trading, offering a multitude of benefits, especially through its libraries and community support. Thank you.
My pleasure, Matthew.
Welcome back to the podcast, Yves. We're diving deeper into Python for algorithmic trading today. So, the book explicitly states it's not a comprehensive Python tutorial, correct?
That's right, Matthew. It assumes a certain level of Python proficiency. We're focusing on using Python for algorithmic trading, not teaching the language itself from scratch.
Right, so what about those prerequisites? You mentioned Python packages for data analysis. Can you elaborate on which ones are most crucial and why?
Definitely. Packages like pandas, NumPy, and scikit-learn are absolutely essential. Pandas is vital for data manipulation and analysis. Think of it as the Excel of Python, for loading, cleaning, and transforming data. NumPy gives you fast numerical computing through arrays and vectorized operations, super important for performance in trading algorithms. And scikit-learn offers machine learning tools, which are frequently used in various strategies. You'll need a solid grasp of these. Hilpish, McKinney, and Vanderplas books are great starting points if you're needing a refresher on these.
Okay, So someone with a Python background in data analysis, say from finance, would be well equipped?
Absolutely. The book leans heavily on that. It's assuming you know how to work with data frames, arrays, and basic machine learning concepts. The focus is on how to apply Python, not why it works at a theoretical level in programming.
Interesting. You also mention IPython and how this book doesn't delve into every financial aspect.
IPython is great for interactive data exploration, debugging, and visualization within Python. The book uses IPython for live coding, which can help you visualize and interact with the code examples directly. As for the financial side, this book is explicitly about the implementation of trading strategies, not a full-blown financial analysis textbook. It focuses on building the Python tools and framework for those strategies.
So, you're taking for granted certain financial knowledge about trading strategies themselves, like momentum or mean reversion, right?
Exactly. While the book uses examples for momentum and mean reversion strategies, it doesn't give a rigorous statistical justification for why these approaches work. It's more like a practical guide showing you how to implement those strategies in Python. The examples are provided to illustrate the programming techniques, not to explain statistical modeling concepts. If you need to delve into the intricacies of those strategies, the book suggests you look at external resources.
That makes sense. This is practical, hands-on guidance for users who are already familiar with the trade and want to make their systems automated using Python. So, to reiterate, if you need a foundational understanding of Python itself, this is not the place to start?
Precisely. This book assumes you have that prior knowledge to implement the trading strategies effectively. It's definitely more of an advanced practical application guide, focusing on putting Python to work in real-world algorithmic trading scenarios.
This makes it incredibly helpful for someone who already has a strong technical background and needs to put their finance skills to use with Python. Great stuff. Yves, thanks for clarifying everything. Welcome back to the show, Yves. We're diving deeper into this fascinating book, Python for Algorithmic Trading. Just to recap, we've been talking about the different algorithmic trading strategies it explores. We're now on the specifics of a few key ones, like simple moving averages, momentum, mean reversion, and machine learning approaches. Can you give us a high-level overview of each?
Sure, Matthew. These strategies, as the book points out, are all focused on generating alpha, meaning returns beyond what the market would typically provide. It's all about finding ways to outperform the market, and they're not relying on market direction itself. So, simple moving averages, for example, aren't just passively following the market.
Right. So, simple moving averages, what's the core idea there?
The core concept is comparing different time frames of average price. A shorter-term moving average above a longer-term one suggests an uptrend. Think of it like a momentum indicator. It's a pretty common technique, used by a lot of technical analysts. They essentially look at how the price has moved recently.
And if the shorter-term SMA is below the longer-term one?
Well, that indicates a potential downtrend, a signal for either a neutral or a short position. So, it's essentially looking for patterns in historical price data to predict future price movements. It's crucial to remember that these techniques aren't foolproof, and the book emphasizes that.
Okay, momentum. What's the underlying philosophy behind that?
Momentum strategies assume that recent price trends will continue. If a stock index has been consistently falling, for example, the momentum strategy assumes that this negative trend will continue. Essentially, they are extending the recent trend, relying on the past.
So, it's more of a statistical continuation approach, assuming similar performance.
Precisely. It's a very common approach, relying on the idea that if something has been going up or down recently, it has a decent probability of continuing that trend. But as you know, markets are complex. So past performance is never a guarantee of future results. And again, these strategies have limitations.
And mean reversion? How does that differ from the others?
Mean reversion strategies assume that prices, if they deviate significantly from a mean or trend line, will eventually return to that level. For example, a stock trading far below its 200-day moving average is expected to move back to that average. It essentially assumes that markets have an inherent tendency to revert to the mean. The book uses the 200-day moving average as a significant reference point.
So, basically, a stock that has drifted away from its historical average is expected to return to it. Interesting. And lastly, machine and deep learning. What's the approach there?
Well, machine and deep learning strategies are a more complex, black box approach to predicting market movements. They generally use historical price and volume data to train algorithms to predict future movements, but the book highlights that this is a bit more of a statistical empirical approach. You essentially train the model on historical data. It's very important to remember, though, that this doesn't guarantee consistent returns.
Welcome back to the show, Yves. We were just discussing how Python is becoming increasingly important in the world of algorithmic trading, and I'm really intrigued by the idea of this book, Python for Algorithmic Trading. You know, there's a lot of buzz around Python's versatility, but how exactly does it power these sophisticated trading strategies?
Yeah, absolutely. Python's strength in finance, particularly algorithmic trading, comes down to a few key factors. First, there's this incredible ecosystem of libraries. Think NumPy, pandas, and scikit-learn, for example. These packages are super efficient for data analysis, which is the bread and butter of backtesting strategies and finding patterns.
So, you're saying that these Python libraries are essential for analyzing large datasets of market data? Can you elaborate on how that works?
Exactly. Imagine you have historical stock prices, trading volumes, and other relevant data points. Pandas, for instance, lets you load, clean, and manipulate that data with ease. NumPy handles the numerical calculations, making complex calculations lightning fast. Scikit-learn helps with machine learning models, allowing you to potentially identify patterns and predict future price movements. And this is really important for developing effective trading algorithms.
Right. And what about interacting with online trading platforms? How does Python facilitate that?
Well, you often have APIs, application programming interfaces, provided by these platforms. Python has great tools for interacting with APIs, allowing you to programmatically place orders, retrieve real-time market data, and execute trades based on your strategies. That's another huge advantage. And you know, those APIs are constantly evolving, so being able to adapt to them through Python is key.
It sounds like this book isn't just about the Python language itself, but also about the application of Python in different trading techniques, such as backtesting. Can you explain that?
Precisely. Backtesting is a crucial step in algorithmic trading. You develop a trading strategy and then use Python to simulate its performance over a historical period, using historical data. This lets you see if your strategy would have made money in the past. It's like a virtual trading lab. The book, as you mentioned, will show how Python is used to implement and evaluate various trading strategies, not just focusing on the code but on the practical application in the context of different strategies.
So, the book's approach emphasizes the practical application of Python in algorithmic trading, not just the programming language itself. Does it cover cryptocurrency trading specifically?
Absolutely. The cryptocurrency market has exploded in popularity, and algorithmic trading plays a major role there. The book will help traders leverage Python to build and test strategies specifically within the cryptocurrency landscape. It's, crucial for navigating the unique characteristics of the cryptocurrency market compared to traditional equities. It's not a standalone cryptocurrency-only guide, but the book will be relevant to crypto-related algorithms.
Fantastic. So, this book bridges the gap between Python programming and the world of algorithmic trading, providing a practical guide for achieving alpha in today's dynamic market. Thanks for the insights, Yves.
You're welcome, Matthew. I think this book is a valuable resource for those looking to enter the algorithmic trading world, or for seasoned traders looking to enhance their toolkit with Python.